let's cut right to the chase. Welcome to This Explainer. Today, we're completely eliminating the fluff and strictly breaking down the 5 most essential technical indicators you need to decode market movements. Look, whether you're trading equities, crypto, or Forex, relying on gut feeling, yeah, that's just a mathematical losing game. So today, we're focusing purely on the data. We're going to build a comprehensive technical analysis toolkit from the ground up, moving from raw, messy market noise straight into highly precise, actionable signals. Let's get into it. Here's our exact roadmap for today. We'll start by decoding candlesticks, then we'll track trends with the EMA, check the RSI speedometer, read the MACD directional compass, visualize volatility, and finally combine it all into one synergistic strategy. Starting off with part 1, decoding candlestick price action. Our foundation begins right at the source, with price action itself. A candlestick is just an incredibly elegant tool for filtering out intraday noise. Instead of looking at a chaotic line chart, you get a clean visual representation of the open, high, low, and close over any specific period. And here's where it gets interesting. When these candles group together, they form highly recognizable structures. Classic reversal patterns like the hammer, the inverted hammer, or the bullish and bearish engulfing setups, these tell a story. They signal exactly when prevailing buying or selling pressure is just utterly exhausted. Think of them as your early warning system that a trend is getting ready to pivot. Looking at these forces side by side, the actual anatomy of a trend reversal becomes super clear. You can visually spot the shift in the real body sizes when looking at the evening and morning stars. What happens is an established trend hits a point of complete indecision, which is represented by that tiny little middle candle. And then it's violently rejected by a confirming third candle moving in the exact opposite direction. That right there, that is raw market sentiment shifting in real time. All right, moving on to part 2, tracking trends with the EMA. To smooth out those daily fluctuations and find the true underlying trend, we absolutely need moving averages. But, not all averages are created equal. While simple moving averages treat all data points exactly the same, which honestly makes them pretty rigid and lagging, the exponential moving average is vastly superior for active analysis. Why? Because the EMA is a rolling calculation that mathematically applies way more weight to recent price changes. It reacts faster, it's incredibly responsive. In fact, tons of algorithmic traders use tight combinations, specifically the 5, 13, and 26 period EMAs, to rapidly spot very short-term bullish or bearish momentum shifts. Now, when we want to identify major institutional-level trends, the relationship between the 50-day and 200-day EMA is absolutely critical. What we're looking for here are crossovers. A golden cross happens when the short-term 50-day crosses above the long-term 200-day, and that signals a massive bullish breakout. On the flip side, a death cross where the 50 drops below the 200 is a major red flag, indicating a severe bearish downturn. Watching these two lines interact brilliantly illustrates the whole concept. The 50-day EMA tightly tracks that short-term trend, right? But its interaction with the 200-day EMA perfectly captures those major macroeconomic shifts. When the 50-day diverges and pulls away from the 200-day, your trend conviction is super strong. But when they converge and cross, well, that means the macro environment is fundamentally changing right beneath your feet. Which brings us to part 3, RSI, the market speedometer. Knowing the direction of the trend is great, but we also have to measure momentum. I mean, is the trend accelerating or is it totally running out of gas? This is where the RSI comes in. It's an oscillator that operates on a strict 0 to 100 scale, and the numbers 30 and 70 are your absolute boundaries. If you see values dropping below 30, that indicates an oversold market. The selling momentum has reached a bearish extreme, meaning the asset is primed for a bullish bounce. Conversely, if values push up above 70, that flags an overbought market, a bullish extreme that's basically screaming warning signs that the asset is stretched and heavily due for a bearish pullback. This tool was actually developed way back in 1978 by Wells Wilder, a former mechanical engineer. And it's brilliant because it doesn't just show direction, it mathematically calculates velocity based on historical average gains and losses. If a price rallies way too rapidly, the RSI spikes, literally telling you to prepare for a mean reversion. It really is your market speedometer. Let's keep building. Part 4, the MACD directional compass. To confirm those momentum readings from the RSI, we turn to the MACD. Honestly, this thing is a genius piece of mathematical engineering. It measures trend conviction by finding the exact difference between a fast 12-period EMA and a slower 26-period EMA to create the MACD line. Then, we lay a 9-period EMA right over that, which we call the signal line to act as our trigger. And the difference between those two lines? That's what you see visualized as the histogram. So, you might be wondering, how do we actually spot a major trend shift before the rest of the market catches on? Well, the true power of the MACD lies in its ability to generate high probability entry and exit signals through very, very precise line crossovers. It essentially functions as an advanced bandpass filter that just blocks out the daily noise. It is all about the crossover. By waiting for the MACD line to cross that 9-period signal line, you can objectively identify exactly when the momentum of a trend is changing direction. If the MACD line pushes up above the signal line, bullish momentum is taking over. Simple as that. If it crosses below, watch out because the bears have taken control. Moving right along to part 5, visualizing volatility with Bollinger Bands. Okay, so with price, trend, and momentum all established, we need boundaries. And Bollinger Bands essentially wrap the price action in dynamic volatility limits. They use a 20-day simple moving average as that middle band, and then the upper and lower bands are mathematically set exactly 2 standard deviations away. This is crucial because it means the bands expand during high volatility and contract during consolidation, capturing roughly 95% of all price movements. So, when the price touches one of those outer bands, you aren't just guessing, you are looking at a statistically significant extreme. Finally, part 6, the synergistic trading strategy. Here is the real secret to algorithmic technical analysis. Using any of these indicators in total isolation, that's just going to lead to false signals and nasty whipsaws. But when you layer them together, each tool brilliantly compensates for the weakness of the others. The RSI handles your momentum extremes, so you don't end up buying at the very top. The MACD confirms the trend timing, making sure you aren't trying to catch a falling knife. And the Bollinger Bands provide those precise volatility boundaries so you can map out your exact entry and exit zones. When you look at a unified layout like this one tracking Apple stock, the power of confirmation is just undeniable. When fully assembled into an automated or systematic strategy, this multi-layered approach strictly filters out the noise. Think about it. A high-probability trade is only executed when the candlestick pattern, the EMA trend, the MACD crossover, the RSI momentum, and the Bollinger Band volatility all perfectly align at the exact same moment. That is how you build a robust system. Ultimately, mastering technical analysis is not about perfectly predicting the future. No one can do that. It's impossible. It's really about systematically managing your risk, filtering out all that emotional noise, and exploiting mathematical probabilities. The tools are right here. The data is completely objective. So the only question left for you is, are you going to continue to trade the noise, or are you ready to strictly follow the signals? Thanks for joining me for this explainer, and I'll catch you in the next one.